Before we talk charts or headlines, tell me honestly, are you holding up right now? Because these weeks have been rough. Whiplash, policy noise, comment wars, and that constant feeling like the rules change overnight. If that pressure is hitting you, you're not the only one. Drop where you're at in the comments, seriously. This channel, Vantage Economics, exists so you don't have to think through chaos alone. And in a minute, I'm going to show you the one data point that makes this whole move feel different. I went through the comments from the last upload, line by line. What stood out wasn't, where's the top, or should I sell? It was people saying, I want to understand. That mindset is rare, and it's exactly who this place is for. If you're here to learn how to read what's happening, not just react to it, you're going to like where this is going. Let's start with the market evidence, because this week didn't whisper, it shouted. Gold is sitting around 598 in Western spot pricing. China reopened after the holiday break, and the first reports coming out of local shops were bizarre. Several dealers stopped selling bars altogether. Even more telling, some buyers are being refunded on agreements made before the holiday. Not wait a week, not back order, money returned. What does it mean when a merchant would rather give cash back than hunt down inventory? It's the physical market speaking in plain language. And here's the context that makes it even more interesting. China was basically offline for much of the week. Traditional logic says, remove a major demand engine and metals should sag. Instead, gold held firm and even pushed higher while absorbing legal tariff headlines, policy uncertainty, and a brief dollar bounce. Now China is back, and the street level is saying the metal isn't easy to source. That is not a pundit's opinion. It's the supply chain blinking red. Silver, though, is flashing a different kind of signal. The speculative crowd, managed money in COMEX silver, has long positioning near the lowest level in roughly 2 decades, even lower than the fear zones of 2008. Yet price just ripped about 16% off weekly lows. So the move happened, and the momentum pack still isn't fully on board. Ask yourself, if silver can jump like that while speculators are barely involved, what happens when they pile in? That's the question most people won't ask until after the big candle. Now zoom out, because the backdrop ties these metals to a wider shift. The $S share of global reserves has fallen to its lowest in about 32 years, roughly 56.9%, down from the low 70s at the peak. Central banks aren't doing that because of social media posts. They're doing it because deficits, debt trajectories, and credibility math force long-term diversification. Meanwhile, combined investor plus central bank gold buying has been hovering around 610 tons per quarter over the last couple quarters, well above a historical demand line that has often aligned with about 3% quarterly appreciation. That's not mysticism. It's documented demand pressure meeting a supply system that doesn't flex easily, especially when physical delivery gets tight. Now the mid-reveal, the layer that S quietly connecting risk assets to metals in a way most viewers haven't T priced in yet. There's a roughly $2 trillion private credit universe that S been helping fund the build-out behind AI. Data centers, compute racks, power infrastructure, the real-world skeleton under the software story. One major player in that world, managing about $273 billion, recently limited withdrawals from a retail fund near $14 billion. When a fund gates redemptions, what's the first thought any serious allocator has? Liquidity. And liquidity problems don't stay polite. Here, I'll ask why this matters. Many of the borrowers tapping private credit are taking on heavy debt to build infrastructure that may not generate meaningful cash flows for years. If AI monetization disappoints, timing, scale, or margins, stress doesn't just hit a tech ticker. It travels into credit structures. And private credit isn't some tiny corner, it's a huge pool of pension and insurance capital sitting in vehicles that aren't designed for sudden exits. At the same time, the U.S. pending home sales index just printed an all-time low, down more than 43% from its peak, with contract closings sliding over 8% in a single month. Housing is a heartbeat industry. When it slows to a crawl, it often signals a broader credit and confidence freeze. So why does this matter for metals right now? Because gold volatility has spiked to the highest level since the financial crisis. Markets don't pay up for volatility unless they see tail risk. This is what Robert Shiller wrote about in the context of bubbles in psychology. Markets often reprice risk before the public narrative catches up. That repricing can look random if you only watch headlines. But if you watch cross-market signals, credit, housing activity, reserve diversification, physical delivery friction, you see a coherent picture forming. Now I want to address something directly because it showed up in the comments. Technical analysis doesn't matter. And depending on your horizon, that's not totally wrong. If you're building a long-term position, fundamentals can do a lot of heavy lifting while short-term noise burns itself out. But here's the truth. Large, disciplined capital still uses sophisticated technical systems, not because they doubt the thesis, but because timing is an edge. Being correct about direction isn't the same as being positioned well through volatility. One can make you money, the other can shake you out. If you're trading shorter windows without a technical framework, you're basically navigating in fog. What works best is the blend. Fundamentals tell you what matters, and technicals help you decide when to press and when to wait. When both line up, macro pressure plus a clear structure on the chart, you get a kind of conviction that doesn't T-collapse at the first scary headline. And that clarity is learnable. Not overnight, but over months. If you keep showing up with the intention to understand, 6 to 12 months can transform how you see markets. Here's what many people misunderstand about technicals, and it connects to silver's behavior recently. Price has habits. Not magic, habits. Certain patterns recur around sessions, weekly cycles, and liquidity windows. Call it algorithms, institutional rebalancing, systematic flows. Labels aside, the repetition is observable. And once you can see it, you stop being surprised by sudden moves. People who recognized a bullish failure to break setup near key levels, or who spotted a reversal structure before it completed, weren't reacting to commentary. They were reading the tape. And the tape often tells a different story than the day's loudest narrative. That's what we're building here. Not followers, independent thinkers who can pull primary data, read structure, and form a conclusion without needing permission. Because the moment you outsource conviction, you rent it from strangers. Now, let's be rigorous and talk about the resistance case, because realism is what separates education from hype. Gold at these levels, with crisis-like volatility, can absolutely see sharp drawdowns without the macro story changing. High volatility markets can move violently both ways. Silver bouncing 16% off lows means short-term traders are sitting on gains, and they'll sell quickly into any believable negative catalyst. The private credit stress is visible, but it hasn't yet produced a headline-grabbing collapse that forces immediate repricing. Until that happens, institutional money can stay comfortable in risk assets longer than skeptics expect. Jim Rogers wrote about commodity bull cycles being full of brutal shakeouts, even while the larger trend remains intact. That's the part that breaks people. The move can still be right, and you can still get shaken out if you're positioned without a plan. The market can slam down, trap impatience, and then continue upward anyway. So what's the counter-argument that keeps the metals case alive? Gold has outperformed the S&P 500 across major horizons, 1 year, 5, 10, and multiple decades. Yet mainstream advisory culture often treats it like a side note. That isn't an accident. Incentives push attention toward products that generate ongoing fees, not toward assets people can hold simply. When that neglect finally shifts, flows can accelerate fast. Now look at silver equities. Miners are roughly 14% from all-time highs, while spot silver is still around 44% below its nominal peak. That divergence is an intermarket tell. Equities are often sniffing out higher future pricing before the spot market fully reflects it. And here comes the headline statistic people aren't respecting enough. Silver has logged 10 straight green monthly candles, an all-time record. Think about that. After aggressive selling pressure, after chaos, after its over narratives, it still closes green month after month. What kind of underlying demand absorbs that much weight without breaking? Here's what it adds up to. Physical gold in China showing real-world friction, dealers refusing to sell and refunding deals, signals tightness you can explain away with a talking head. The dollar's reserve share is at multi-decade lows as central banks diversify. Silver has massive upside torque if speculative positioning re-enters from historically depressed levels, and a giant private credit system is throwing early liquidity smoke while housing activity hits record weakness. These aren't isolated stories. They're one story showing up in different places at the same time. Clarity beats prediction when the world gets noisy. The chart moves first, the crowd explains later. This is education, not financial advice. You own your decisions, but you don't have to make them blind. If this helped you connect the dots, hit like and subscribe to Vantage Economics so you can keep building that independent lens. And tell me below, what data point are you watching that others are ignoring?